So how do you see this, going forward? Because we have, very well-performing ARCs who are doing good work. We also see banks trust in the ARCs, and therefore there is uh, increased sale of assets or assignment of assets with the banks to the ARCs. So how do you see, 4 years, 5 years down the line? Because when we see our SARFAESI and insolvency related segments, we see that yes, the number of opportunities maybe that are coming IBC way are lesser as compared to 1 year earlier or 3 years earlier, much lesser than 5 years earlier.
Let me try to explain you with some numbers actually. These are NPAs of banking system as a whole, and from 2020 to 24, like gross NPA at the beginning of the year 2020 was 9,15,000 crore, which has come down to say closing balance 2024 4 lakhs 80,000. So there is a substantial reduction in NPA as appearing in the balance sheet. I again repeat the word, as appearing in the balance sheet. Now let's see what is the amount written off. Written off from 2020 to 24 is 10,11,000 crore. So assuming even a fraction of that, maybe 1/3 or maybe 25% is technical write-off, where accounts have been written off just because they have crossed 4 years, because we are in the regime of time-based write-off provisioning norm. So in that case, still there are 3-4 lakh crore available, which is not appearing in the balance sheet. On an average, let me just give you another number again from that trend NPA analysis of bank.
So good morning, everyone, and welcome back to our weekly webinar series. At episode number 168, we are continuing our discussion on ARCs. We have the pleasure of having with us Mr. Hrihar Mishra. He's the Chief Executive Officer of the Association of ARCs in India. He has been part of, or he has been representing ARCs through this association since April 2023. Before this assignment, Mr. Mishra has been associated with the ARC sector since its inception, having worked in different ARCs at various roles, including that of director from 2004 onwards. Prior to joining ARC sector, he was a career banker, having joined State Bank of India in 1982 as a PO and working in various areas of banking, including credit management. He has been associated with various committees, including IBA Committee on NPA Loan Process Flow, Information Checklist for Loan Sales, and standardization of transaction documents like assignment agreement. His view and articles on economy, finance, banking, stressed assets, and resolution mechanisms like IBC are published in various publications on regular basis. So he speaks at various academic professional institutions on topical interests covering economy, banking, insolvency, ARCs, NPA management. Welcome, sir, to our webinar series, and it's a pleasure to have you with us.
Thank you very much.
Thank you, Ankit. And while I welcome all the participants into episode 168 of AAA Weekly Webinar Series, so this is a continuation of our education series on asset reconstruction companies. In the past, we have invited two experts for giving us practical inputs about the ARCs. One, Mr. Sanjay Tibrewal, the CEO and Managing Director of Phoenix Asset ARC. Then Mr. Chandan Churiwal, who is the Managing Director and CEO of Acre. Now we have the person who has the most experience in the asset reconstruction companies segment in India. Like he is the CEO of the associations of ARCs in India, and this ARC is this association is not pretty old, but I think it has surfaced and it has gained importance with the leadership of Mr. Mishra. So I would request Mr. Mishra to say something about himself, about this association, and also the overall present position of ARCs in India regarding their business viability and the outlook for ARCs in India. welcome to Mr. Mishra, and over to you.
Thank you, Mr. Anil. At the outset, let me express my thanks and deep gratitude to you for having organized this series of webinars on asset reconstruction sector. This is a very good initiative and I really welcome this, and thank you very much for taking this initiative. As far as my profile is concerned, already Ankit has read out a small one, but I have been associated with ARC industry activities from 2011, when there was a key advisory group on ARC sector reforms appointed by Ministry of Finance that had stakeholders from all segments like the regulators, RBI, SEBI, the law firms, the rating agencies, banks. So that was a comprehensive committee on ARC sector reforms, and that time association didn't have an office of its own, it was operating from IARC. So I had the privilege of drafting the whole key advisory group reforms report based on the input received from various stakeholders on mail, on discussions. Since then, I have been associated with various industry level activities at IBA, RBI, CAFRAL. As far as ARC sector outlook is concerned, before going into specifics, I would try to highlight two distinct characteristics. First, ARC is a debt aggregator platform. IBC came in 2016. 5 years later, government felt the need to have an ARC. Why is it so? Because Indian banking is dominated by consortium lending, and debt aggregation becomes a key component of resolution, and a particular threshold has to be achieved before you can resolve, which could be 60% in Perpetuity, 66% in IBC, or various other forums. So this debt integration is an integral part, and ARC is a platform which is well suited to have this debt aggregation. And that's the reason, even after 5 years of IBC, government felt the need to have an ARC which could aggregate debt of at least large advances so that resolution becomes faster. That's number one. Number two, as a fundraising instrument, the security receipts is a very important tool because investors can participate in a country's distressed debt opportunity through some specified instrument, and SR does really help in attracting foreign investment. In fact, in 2018, FI investment in SR was only 500 crores, which went up to 20,000 crore by 2024. So 40 times increase in FI investment increase in 6 years time from 2018 to 2024. So that shows as an instrument which are issued by ARC that gain a lot of traction in attracting foreign money into Indian distressed debt. So apart from all other characteristics which we have been discussing in the last few webinars, these two critical components will try to have a bearing in the resolution framework, and ARC will continue to have a lot more relevance. Apart from that, the experience that ARC have gained in the last 20 years, the resolution skill set they have, the resolution platforms they have, obviously, I mean, nobody can start from a scratch nowadays and compete even if some other alternate mechanisms which are in the pipeline are there. And ARC will continue to be the first choice among all investors whenever resolution comes to mind. So we'll discuss details throughout the webinar. That's the preface. And as far as ARC performance is concerned, I mean, last year we did have a good year in terms of recovery. While acquisition slightly lagged behind redemption, but the recovery performance was pretty good. And SR redemption, which used to be a concern for many of the participants, including bankers, have substantially improved, which has been reported by Reserve Bank of India also last year, trend and progress of banking. And this year also, CRISIL estimates the recovery would substantially improve because of improvement in real estate sector and infra projects, as the economy is doing pretty well. With this, I'll hand it over to Anilji to continue his presentation. And please feel free to ask any question, give any feedback, give any suggestion at any time that you feel So this is a free for all. So please don't hesitate to ask any question or give any feedback. Over to you, Anil.
Thank you very much, Mishra ji. So this is really a wonderful input at the beginning. So we will pick your brain in between. So now I think the people have already started raising hands. But of course, we will take the questions at the end. I would request all the participants to bring all the practical questions to Mr. Mishra. Today, we have the opportunity of having him here in our episode. So we will continue our education on this today in this episode. We would be discussing the various compliance issues, accounting issues regarding ARCs, and like what kind of directors or what kind of managing directors are acceptable by the Reserve Bank of India. That's what we are going to discuss. But before we do that, we actually would like to say that in the last 3 or 4 in the last the ARC series, we have already touched the entire all sections of SARFAESI Act, and we are presently continuing with the RBI's Master Direction on Asset Reconstruction Companies 2024. Then we also have seen like only the registered ARCs can only take up the work of the work of securitization and reconstruction, and ARCs can also participate into submitting a resolution plan under IBC for acquiring any company, but for that purpose, net owned funds are supposed to be at least 1,000 crores for that ARC. Investment in other ARCs is allowed, and then the ARC must have board approved policies regarding how to do due diligence, how to do the valuation and methodologies, etc. Acquisition of financial assets must follow transparent, fair, and value principles. So all this we discussed, and then also we discussed the actually, which is the most important part of the Reserve Bank of India's master guidelines and also SARFAESI law, which says that what are the options available with the ARCs to resolve and to realize the value and to maximize it, like the changing the management, sale and lease, and the rescheduling the borrower, of course, settlement of dues, and also like enforcement of security interest. Then we today we also, in fact, in the last episode, along with Mr. Chandan Churiwal, we also discussed the practical parts about security receipts, the special features of security receipts, why the security receipts are placed in a trust, and also the rating and the grading of the security receipts, and also the valuation valuation of security receipts, prudential norms about security receipts, asset classification, provisioning, all requirements by SRI. Like this is what we have discussed in the last episode, and today we are actually discussing governance and conduct. Let us first start with the board of directors of ARC. Now, the board of directors of ARC, there are 4 or 5 such positions where the RBI's written approval is required for appointment or reappointment of director, managing director, or CEO. So this is where the like when we say director, it is the whole time director. Like the RBI's written approval is required, and there is a process. And while the RBI is giving this permission, RBI is making sure that the ARC must perform due diligence on all the candidates, and that should be based on the track record, the integrity, and fit and proper norms. So there are fit and proper norms that we again will discuss slightly later. And then the ARCs are also required to submit a declarations in Excerpt 2, which is vetted by the Nomination and Remuneration Committee. So each ARC must have a Nomination and Remuneration Committee, which is also otherwise required for a listed company under the SEBI guidelines. Then application has to be made to RBI, and that must be filed. That application must be filed at least 90 days before the appointment. At least 90 days before the appointment, because the RBI thinks that RBI will take 90 days in doing the due diligence of the proposed candidate. Then when we come to the fit and proper criteria for directors and CEO of ARC, it is the annual update is also required for fit and proper persons. It has to be reassessed on every 31st March. Then there is a covenant that any director of ARC must sign a covenant committing to ethical discharge of duties. That is also provided in Annexure 5 of the RBI Master Guidelines. The RBI has also stipulated the age limit and tenure. Now, the managing director, the CEO or whole-time directors, they can continue. They cannot continue beyond 70 years. However, the ARC board may specify a lower internal retirement age. Then the tenure of a managing director, a whole-time director, or a CEO, that is maximum 5 years per term. And in total, 3 terms can be given to a person in continuation. And in case there is a case where this position is supposed to be given even after 15 years, then there is a mandatory requirement of 3 years of cooling period. And at that particular time, in those 3 years, that person will not have any kind of association in any capacity with the ARC. And ARC also must have a succession planning, and that also be placed before the board and approved. Then the RBI also even stipulate how the board meetings will happen, who will chair the board meetings, and how the performance of the key managerial personals will be reviewed. So then in this case, the RBI says that the board chair must be an independent director. The chairman of a ARC must be an independent director. Secondly, in case the chairman of the board is not available, then that meeting will be chaired by any other independent director. Then the quorum of the board meeting would be at least 3 members or 1/3, whichever is higher. So in case there are 6-member board, then 1/3 is 2. Or in case it is 9 members, then in case it is 12 members, then 1/3 is 4. However, minimum 3 directors are required, whichever is higher. So in case there is only a board, there is a board of 4 members only, then minimum 3 would be required. And at least half of the attending directors must be independent. At least half of the attending directors must be independent. And there is a requirement of annual performance review and appraisal for managing director, CEO, and whole-time director, and that is required to be done by the board. I would like to ask one question here from Mr. Mishra. So, Mishra ji, please, can you just give some highlights in the industry? What is the tendency? How many members in the board is considered to be appropriate, considering the quorum, considering the independent directors? How many directors in a ARC is considered appropriate? Very, very simple and brief question. Mishra ji.
Look, all the changes were notified in 2022. This was based on some of the recommendations of a Sudarshan Sen committee, which went into functioning of ARC.
I would simply request you to speak a little loudly, because I think the voice which is coming to the audience is slightly lower. Or you can go closer to the mic.
So all these recommendations, all these changes were made in October 2022. Some of them were based on Sudarshan Sen committee recommendations, which went into working of the asset reconstruction companies. What they emphasize is that oversight mechanism at ARC has to be strengthened, and all these measures are intended to strengthen the oversight mechanism with independence of directors and with autonomy. And the covenant that you were referring to earlier In fact, that not only is to be signed by the directors, it's to be signed by ARCs in terms of giving adequate information for them to take a decision. So the whole process is to strengthen the oversight mechanism. Number could be different, but most of the ARCs have independent directors numbering more than the nominee directors, because there are certain provisions like conversion of debt into equity. It's 26% for all ARCs other than where the majority are independent directors. So there are certain benefits if you have majority of directors as independent. So now most of the board have more independent directors. And of course, when this circular was issued in October 2022, and those ARCs who didn't comply with this, they were given a 6 months time to comply with all these things. Like, for example, audit committee to be chaired by an independent person. There were some exceptions. So, like, chairman, MD, that used to be combined post some time. So all those non-compliances, ARC is given 6 months to comply with, and everybody had complied by 6 months by March 23. Numbers depend on different ARCs. There is no bulk part figure. This would be the number. But bigger the number, it gives a representative view of more representative view.
Right. So, see, going forward, there are committees which are which are mandatory for an ARC, and the first such committee is the audit committee. In the audit committee, the RBI says that the only non-executive directors would be participating into the audit committee. It will be chaired by an independent director, and that independent director should not be the chairman of the board. Then the audit committee must have the quarterly meetings, and the quorum for the audit committee is 3 directors. The members of the committee must understand financial statements. At least one member must have the financial expertise. Then the functions include the review of internal control, asset acquisition, management fee compliances, etc. And the second committee, which is important, is the nomination and remuneration committee. This is similar to the committee which is required to be made by the every listed company in India under Section 178 of the Companies Act. So this also, like any person who is getting remunerated at key positions, should actually have the fit and proper criteria must be fulfilled for the directors and the sponsors in the case of ARCs. However, when we go to Section 178 of the Companies Act 2013, it says that the every listed public company and other such class or classes of the companies as may be prescribed shall constitute the nomination and remuneration committee consisting of 3 or more non-executive, out of which not less than 1/3 shall be independent directors. So this is a requirement which is almost matching the Section 178 of the Companies Act. Then we are discussing today the fit and proper criteria for the sponsors and for the investors. Now, for the sponsors and the investors, now let us understand the fit and proper criteria. Now, the RBI makes an assessment about fit and proper person with regard to the investor and sponsors. Now, the sponsors and investors are those people who actually would be considered as promoters of the ARC. They would be having financial interest in the ARC. The RBI will assess their reputation, their regulatory compliances, their corporate governance history, and the funding sources. RBI will also see the impact of the shareholding agreement on control of the ARC. Definitely, RBI would not be interested that only 1 or 2 persons should have the entire control of ARC. Then, with regard to the fit and proper person, there are declarations which are supposed to be submitted. Declaration by sponsors, which is supposed to be submitted in Form 1, Part A, B, and C for all categories. And for regulated entities, the Part D is to be submitted. However, the ARCs are also required to submit Part E as well. When ongoing monitoring by RBI, it also has a procedure of annual declaration collection. ARCs has to obtain this kind of declaration every year by the end of April. And this declaration will be as on 31st March every year. The Form 3 is prescribed for this, and it has to be submitted to RBI by end of May every year. Then adverse information reporting, the report promptly and adverse information on the sponsors to the RBI. That is the duty of ARC, that if there is any adverse information about sponsors or investors, it must be submitted to RBI. That's the requirement. Then the RBI says that prior approval of the RBI is required when for a new sponsor, or when a sponsor wants to exit. For that purpose, RBI's special approval is required. In case any investor or shareholder, in fact, cumulatively transfers 10% of more paid up capital within 5 years from the certificate of registration date, that also would require RBI's prior approval. Then the RBI also asks that the Form 2 would be submitted with the data for required approvals. But here this Financial Action Task Force, FATF, that also is in picture, because the FATF, the Financial Action Task Force, in fact, from time to time, they keep on classifying some jurisdictions which are high-risk jurisdictions. And high-risk jurisdictions, as on today, it has been, it's basically, this reflects that there are significant strategic deficiencies in this jurisdiction or in this country, and are subject to mandatory countermeasures across financial system. And like in case we see the North Korea is one of such jurisdiction, Iran and Myanmar, Burma, these are the three such jurisdictions which are considered to be high-risk jurisdiction, and any person who actually is from these three jurisdictions, I believe, would not be permitted as sponsors or as investors. However, there are many other countries which are classified as the jurisdiction under increased monitoring. They call it gray list. The North Korea is in blacklist. However, there are many other countries which are in gray list, like Algeria, Angola, Bolivia, Bulgaria. So some of the African countries like Kenya, Morocco, Nepal, Nigeria, South Africa, South Sudan, like all this, Vietnam. So these are all areas which are considered to be gray list and blacklist. So investors which are coming from these jurisdictions cannot acquire significant influence that is equal to or more than 20% voting power is not allowed to them who are from the gray area. And then existing investors, as like this, because this particular notification came on 12th of February 2021, so the existing investors may continue and invest further as per regulations, because this particular notification was effective from 12th of February 2021. So any such person from such blacklist or grey list jurisdictions can still continue and invest further in as per the regulations. So then there is a fair practice code in the RBI master guidelines. And the minimum standard which is required is that the fair practice code policy must be approved by the board of the ARC. Now, the fair practices code, what it says? Number one, it says that the asset must be acquired transparently and non-discriminatory. Then it says that the sale of the assets must be through a public auction, and the public invitation should be to all. Then the broader consultation with security receipt investors. Then ensuring compliances with Section 29A of the IBC. Section 29A of the IBC has some of the eligibility criteria, and those must be fulfilled for becoming a sponsor or an investor in ARC. Then whenever there is a recovery, on full recovery, unless valid set of claim exists, the securities must be released. Then the management fee must be reasonable, transparent, and board approved, and it should be charged only from recoveries and must specify the caps and limits. So then the Fair Practice Code continues, says that whenever there is a policy of outsourcing, like there are the ARCs also invest resolution agents, like AAA Capital Services. In fact, AAA Capital Services Private Limited started in 2002 when SARFAESI law was promulgated in India. This is where the AAA Capital Services Private Limited, in fact, started functioning. That is called outsourcing policy. Like the banks had outsourcing policies, ARC had outsourcing policies, NBFC has outsourcing policies. So therefore, whenever these entities, for the purpose of enforcement of security interest, they try to engage outside agencies, so then there should be an outsourcing policy, and that policy should be comprehensive policy, and it should actually ensure that there is no conflict of interest, especially where the vendors are linked to ARC directors, So the enforcement agent will be called a vendor for the ARC. So it is said that the enforcement agent should not be related to the directors of the ARC, and therefore this outsourcing agency, the resolution agent should maintain the regulatory oversight capacity. Any work done by the outsourced agency, the ultimate responsible will be ARC only. So when the outsourcing agency, you may call it a recovery agent, you may call it a resolution agent, you may call it a support service, whatever name you can give, but the agents of this outsourcing agency should actually follow this code of conduct. They maintain the customer friendly and confidentiality. They should avoid harassing to the customer or borrower. They are not supposed to call before 8 a.m. or after 7 p.m., or they are not supposed to even use threatening, abusive methods. ARC is also, as I said earlier, ARC is in fact liable for the actions taken by all these agencies. Then, as far as the fair code, Fair Practices Code is concerned, the ARC is supposed to have internal mechanism with designated officer for grievances redressal, of grievances. Then there should be a complete mechanism where the complaints against ARC or agents or outsource vendors are completely addressed. Confidentiality has to be maintained, and regarding it is required by law. It is public interest dictates that. So then this Fair Practice Code, the Fair Practices Code, also should be reviewed regularly by the board of the ARC. So these are and then Fair Practices Code also says the public disclosure, and which the Fair Practice Code must be placed in the public domain of the ARC. Then additional guidance, ARC to follow RBI circular dated September 13, 2023 regarding the responsible lending conduct and release of loan documents upon settlement. So these two things, in fact, were catching the attention of RBI. So on 13th September 2023, the RBI circular says that the ARC would be responsible. They should be responsible as a lender, as their conduct should be responsible. So then we actually would like to ask at this moment a little practical insight about all this kind of fair practices code, how the ARCs are assuring that the fair practice code is completely implemented. Mishra ji.
Regulator has been emphasizing on this adherence to fair practice, transparency, governance standards. In fact, in a meeting with directors and CEOs of ARCs last year, RBI did mention something called Regulation Plus. They said that not only you should ensure that whatever regulations are prescribed, you have to abide by that. You have also to see the spirit behind those laws and must subscribe to those spirit actually, in addition to the latter part. ARCs in general, every ARC has improved in terms of requisite transparency, disclosures, customer centricity. Everybody has a designated customer grievance officer. Fair practice code is displayed in the website that's redressed wherever there is a complaint. One thing probably this didn't come here, but for foreign investors, there have been significant amount of disclosure. I think Anil ji had covered in the last SR issuance. Now all the investors in SRs would get a full picture of last 5 years financial performance of ARCs, last 8 years performance generated for the investor, last 8 years rating migration of all the SRs issued by ARC. So this is a big comfort to foreign investors. In fact, in a global NPL meet, which I addressed 6 months back, many of the investors were not aware of the changes which were made recently in the last 2-3 years. And that gave a lot of comfort, because now before you can invest, you can know detailed performance of their financials, of their rating performance, of their individual of their return generated to investor. So in last 2-3 years, the amount of disclosure, transparency and conduct of ARC have substantially improved, much though obviously there is still room for improvement.
Ankit, any comment from your side on this subject so far, like the fair practices code or whatever we've covered?
I believe that these are, such regulations are very important to build trust. And as Mishra ji said, that since the idea is that a lot of foreign investment and other investors are now interested in the distressed asset segment, these regulations help build that trust. Because in case you have any incident that happens in one ARC, then it can actually, bring some kind of a doubt on the entire industry. So I think the entire industry, and I think it is led by the association that Mishra ji is leading also, would want to have a global picture which is clean and which is based on clean practices. So I believe it's good that these disclosures and this all practices, that independent directors will be leading the board meeting, leaving the actual operations to the operational people reporting to the board of directors. So all these are very good practices that sometimes we even miss in very large listed companies, but they seem to be in place in ARCs.
See, good. Thank you, Ankit. I think we can move forward and we can discuss this when the slogan for the ARC is the leading with integrity, embedding governance and ethical conduct. And in this particular part of the webinar, we will be discussing accounting and disclosures. Now, the guidelines of RBI guidelines regarding accounting, it says that the financial statements, that means balance sheet and profit and loss account and fund flow, that to be prepared as on 31st March every year. Then in the financial statements must classify the liabilities which is due within 1 year, and that should be classified as current liabilities, and assets maturing within 1 year plus cash and bank balances should only be shown under the current asset. So those assets which can be recovered within 1 year, those only can be classified as current assets. And also the accounting must comply with RBI prudential norms. Any departure any departure from provisions, prudential norms, income recognition, that in fact must be disclosed with reasons and financial impact. One, the reason must be given that we are not complying with any of the directions, number one. Number two, what is the financial impact of that kind of qualification which the auditor may give? So if the auditor has given a qualification, it must come with the financial impact on the financial statements. That can be financial impact on the profitability and also net worth, and also various other debtors and creditors. So therefore, the accounting policy which is adopted by the ARC, that needs to be disclosed, or that needs to be disclosed. But in case there is any inappropriate accounting treatment, that is not acceptable, even if it is disclosed in the accounting policy or it is disclosed in the notes. But the financial impact, accordingly, the books of account, the financial statements are not changed. So that is something which is not acceptable by the RBI and the ARCs, which are covered by Rule 4 of the Companies Ind AS Rules 2015. The ARC in that case must adopt Ind AS. Then the regulatory guidance issued by the RBI circular dated 13th March 2020 that applies from financial year 2019-20 onwards. So here the accounting, for the purpose of accounting method, the method, in fact, there was an amendment effective from 1st April 2017. And in that amendment, the amendment is basically the adoption of Ind AS. So the Companies Act, which says the Rule 4 of the Companies Ind AS Rules 2015, it says, which was also amended from 1st April 2017, and it says that the companies, who all are the companies where this adopting Ind AS is mandatory. One, the companies whose equity or debt securities are listed or are in the process of being listed on any stock exchange in India or outside India, and having net worth of less than 500 crores. So when I say Ind AS, adoption of Ind AS is presently restricted to two kind of companies. One, where the total net worth is less than 500 crore, and also the company is listed, the equity or the debt securities are listed or are in process of getting listed. So therefore, Ind AS is required to be implemented. Then Ind AS is also required to be implemented nowadays on those companies which are even unlisted, but their net worth is between 2050 and 500 crores, and any holding company, subsidiary company, and joint venture or associate companies that will also adopt Ind AS if the main company is complying with the requirements of Rule 4 of the Companies Ind AS Rules 2015. So this is regarding the applicability of Ind AS. Regarding investments in the financial statements of an ARC, first of all, in case we talk about the security receipts as investment, then how do we treat the security receipts in the books of accounts with regard to the income recognition, with regard to the asset classification? So then the security receipts will be classified as available for sale because underlying cash flow are dependent on realization from NPS. So this is classified as available for sale because underlying cash flow are dependent on realization from NPA. Then in case the investment is depreciated, then it must be provided for. In case the price of SR, In case the price of security receipt is less than the acquisition price, then it must be provided, and accordingly the loss may be booked in the financial statements of ARC. However, uh, in case it has appreciated, however, in case the investments have appreciated, and that is only restricted to the investments which are permitted under the SARFAESI law, where the ARC can invest. No, that you see net appreciation, in case there is appreciation, that should be ignored. Regarding the investments other than security receipts, one, that it has to be valued at lower of cost or realizable value. In case market rates are available, then the market value would be is equal to realizable value. In case no market rate is available and the fair value is the realizable value, then the fair value is the realizable value. Investment in other ARCs treated as long-term and as per applicable standards, that actually would be treated as long-term. When we come to the income recognition, the yield and upside income on SRs, that has to be recognized only after full redemption, The management fee will be recognized in the books of account on percentage of NAV at lower end and the recovery rating range. Prior to NAV availability, charged on actual outstanding assets. NAV availability charged on actual outstanding assets. The fee realization also, there is an accounting principle, there is an accounting direction for fee realization. So it is to be recognized in the books of accounts on accrual basis. However, in case the fee is which is already accrued, if it is not realized within 180 days from the expiry of planning period, or if it is 180 days from the date of recognition, if after the planning, so then the accrual must be done. Then income must be booked. So in case the SRs are not realized within the time frame, then all these fee which is recognized, that should be reversed. So the NAV of these SRs, if it drops by 50%, in the value, then the reversal of the fee also should be made, only because the recoverability is very slow. Now, when this Ind AS was supposed to be applied on ARCs, then there was one impact on the financial statements, that is unrealized management fee must be deducted from net owned funds and dividend pool. So net of expected credit loss provisions and tax impact. So this is something which is in the purview of the audit committee. Now, regarding other income, that has to be recognized as per the standard accounting principles. For NPA, the interest and charges only on actual realization. For NPA, the interest and charges only on accrual basis. So, and then pre-NPA unrealized income to be de-recognized in C. So this is something which is an accounting part of it. There are a lot of things that we are supposed to disclose in the financial statements of the financial statements also. I think, Ankit, can we take some of the questions, because the time is moving up, and I think some of the disclosures I will see in case there is anything that we can take up slightly later. So in case you can see some of the questions are there, so I can stop sharing my PPT for the time being, and we'll again come back when in fact in case there are no questions, or in case there are some questions which comes in your mind, you can also ask, Mr. Mishra.
Any of the attendees who would want to ask a question, they can either put it on the Q&A or raise their hands. I think we can then have that question.
So in the meantime, I can ask one question from Mr. Mishra regarding all this accounting of the ARCs. Do you think that the accounting is very tight, and it is not possible for the ARCs to show anyway some kind of window dressed profits. Do you think that the RBI is able to fully monitor and control it?
Look, now management fee can only be realized from the recovery from the underlying assets. So you have to perform to earn management fee. Like in banking, many of the bankers should be attending here. There is something called lazy banking, where you raise deposit and say invest in government securities and earn this spread without doing much effort or taking much of risk. Earlier, there was a perception that ARCs used to have that sort of a income where, they just used to charge management fee irrespective of the realization. Now, all management fee has to come from recovery, number one. And if its realizability falls down, when NAB falls down below 50%, they cannot realize management fee. So now management fee is completely performance based. There is no fee that you can earn without really putting up effort actually. So this has improved the performance of assets considerably. Now they have to earn every pie of it.
So I have one more question. So in the present economic situation that we are in, of course, we see that yes, the NPA is down, the market that is available for ARCs or the assets that the ARC has or available to take over from banks is also diminished. Whereas we understand that ARCs are flush with funds and they would want to invest more into distressed assets. So how do you see this, going forward? Because we have, very well-performing ARCs who are doing good work. We also see banks trust in the ARCs, and therefore there is uh, increased sale of assets or assignment of assets with the banks to the ARCs. So how do you see, 4 years, 5 years down the line? Because when we see our SARFAESI and insolvency related segments, we see that yes, the number of opportunities maybe that are coming IBC way are lesser as compared to 1 year earlier or 3 years earlier, much lesser than 5 years earlier.
Let me try to explain you with some numbers actually. These are NPAs of banking system as a whole, and from 2020 to 24, like gross NPA at the beginning of the year 2020 was 9,15,000 crore, which has come down to say closing balance 2024 4,80,000. So there is a substantial reduction in NPA as appearing in the balance sheet. I again repeat the word, as appearing in the balance sheet. Now let's see what is the amount written off. Written off from 2020 to 24 is 10,11,000 crore. So assuming even a fraction of that, maybe 1/3 or maybe 25% is technical write-off, where accounts have been written off just because they have crossed 4 years, because we are in the regime of time-based write-off provisioning now. So in that case, still there are 3-4 lakh crore available, which is not appearing in the balance sheet. On an average, let me just give you another number again from that trend NPA analysis of bank. From 2020 to 24, addition during the year was 14,97,000 crore new NPA which came into the system. On an average, it comes to 2,99,000, say 3 lakh per annum. To 2020 to 24, 3 lakh per annum has been added. Maybe now with much better credit portfolio, this would come significantly lower. Say let's assume it will be 2 lakh. And recovered during these 5 years has been 5,54,000, which is on an average 1 lakh crore. So if you dissect the numbers, on an average, banks have been adding up 3 lakh crore NPAs every year from 2020 to 2024. On an average, in last 5 years, they have been recovering only 1 lakh crore. Rest 2 lakh crore is 2 lakh crore write-up on an average for last 5 years. And a part of that write-up could be technical write-off, which is still available for sale to ARCs, which may not be appearing in the balance sheet. So,
Right.
though gross NPAs are at a decadal low as per the balance sheet, there is still a lot of NPA stocks available in the system for ARCs to do. And these are cyclical. Now we are at a cyclical low level. There will be some time again, there will be an uptick. Like for some time, there was a stress in retail, MFI. So it could change actually.
Right. And I think this is something which is a very interesting insight that yes, these numbers are very insightful. That yes, these are the kind of NPA numbers that are still there in the process, in the banking process. And I think our audience would understand that this is also, opportunity for those professionals who are working in the stressed asset segment.
Hmm. So I think we have a little bit of subjects which can still be covered, and that subject I think we can. Our audience definitely would be interested in getting that covered. So we are very briefly we are saying that the what exactly disclosures are required to be made in the financial statements of an ARC. So the financial statements of the ARC, like the balance sheet and the profit and loss account and fund flow statement, that actually must also have the information about the banks and the financial assets from whom the assets are acquired. Their name, address, acquisition value, etc., must be stated in the financial statements. Industry-wise sponsor and a sponsor-wise segment of segregation of assets, related party details, and amount due, movement of assets from standard to NPA, that must be shown in the financial statements, and the value of acquired asset, value of realized assets, and outstanding for realization, which is balance realizable, that also must be stated in the financial statements of ARC. And the regarding security receipts, the financial statements must include fully and partially redeemed pending redemption and not redeemed due to non-realization. Regarding land and building, the ARC must disclose whether it is acquired for reconstruction year-wise, and the valuation methodologies where acquisition is having more than book value, acquisition value is more than book value, then valuation methodology has to be given in the financial statements. Assets written off or sold, which is at a discount of 20% or more, along with the reasons, has to be disclosed in the financial statements. Security receipts which are down in value by more than 20% also has to be shown in specifically. The outsourcing agency details, like in case any ARC appoints AAA Capital Services for outsourcing various enforcement of assets as per the SARFAESI law, then it has to be given in the financial statements. It has to be disclosed and also have to be stated that none of the director of ARC is interested in this outsourced agency. IBC acquired, assets acquired through IBC, its type, value must be given, and the quarterly status on the IBC resolutions implementation. IBC resolution plan implementation quarterly status report is required to be submitted to the RBI. Then aging of unrealized management fee is also required to be submitted disclosed in the financial statements. Then the ARC must file a return as per RBI master directions on filing of supervisory return. Then the audited balance sheet must be submitted to RBI regional office within 1 month of the AGM, and the in case any case has to be reported to RBI for where the management, the taking over of the borrower's management, because as per SARFAESI, ARC has the powers to take the management of the borrower. So that in case there is any such action taken, that must be disclosed in the financial statements. There are some miscellaneous instructions, like the ARC must have an independent and effective internal control system, and it must have a periodic review of assets acquisition procedures, assets reconstruction measures, and the guidelines regarding the credit information companies. The credit information companies are also the ARCs are supposed to. The ARCs are supposed to give information to credit information companies. So in fact, in India, there are 5 companies which are licensed from RBI as credit information companies. The first and the oldest is CIBIL, and then CIBIL. Then we have others like there are other the companies also but CIBIL is the oldest, which started in 2000, and the other three, in fact, started late in 2010. And then it is mandatory that the ARCs must become a member of credit information companies, and the data regarding willful defaulters
Anilji,
must be...
one small interruption.
Yes, please.
This RBI master circular has not been updated. Now all regulated entities are required to be member of all credit information companies. So ARCs are now required to member of all CICs, not one equity. I mean, this master direction has not yet been updated. There has been separate notification on that.
So that's very good. Like now they are supposed to be member of all the five CICs, all the five CICs, and then they are supposed to submit the information, quarterly information, to all the CICs regarding the willful defaulters, regarding the suit filed accounts of willful defaulters, and it is also supposed to be posted on the ARC's website. And it is the willful defaulters are supposed to be as per the RBI guidelines. So there are other circulars which the ARCs must adhere, and those circulars are September 2003. I think these are the circulars that you are talking about, which probably is not merged into the master guidelines. Then the other requirement that the CERSEI, the Central Registry of Securitization, Asset Reconstruction and Security Interest of India, CERSEI, ARCs must file all transactions related to securitization, reconstruction, and creation of security interest before CERSEI. And the ARCs are also supposed to submit their information to information utility as per the RBI circular dated 19th of December 2017 regarding submission of financial information to information utilities. Then regarding the Know Your Customer KYC directions 2016, those are also applicable to ARCs to follow up from time to time. And also reporting to IBA is also mandatory. ARCs must report to IBA regarding the chartered accountants, advocates, valuers who have committed serious professional irregularities. And before reporting, they are supposed to follow IBA procedural guidelines, and also give concerned parties opportunities to respond within 1 month. This is something which is it's like all these are compliances, like what we have so far said. IBA reporting to IBA, reporting to CIC, reporting to CERSEI, reporting to IU. All this is like kind of mandatory for the ARCs, and there are some kind of penal consequences also for various non-compliances. And there are in SARFAESI law, there are a lot of penal and prosecution sections are available. So we need to understand, one is the section 29 of SARFAESI, which talks about the imprisonment for 1 year and fine. Then it also talks about the cognizance of this prosecution. The no court shall take cognizance of any offense punishable under the SARFAESI law, and that actually has to be done by at the instance of CERSEI, or it has to be done at the instance of RBI. And the court before which such trial will be handled, that is the metropolitan magistrate or a judicial magistrate of the first class. That is where our prosecution will handle. And section 30 capital A was introduced, where the RBI has the power to impose penalty on the ARCs, and that actually can be up to 1 crore of rupees. So these are the various penal provisions, but this is all that we have for today. We have completed the series on asset reconstruction companies, but we are still studying, and we are collating all judgments by Honorable Supreme Court and various high courts, which has got issues regarding SARFAESI and ARC. master guidelines from RBI. Only on those issues we would be collating the judgments, and that will be our next episode, which is episode 169. So this is our entire effort on the ARCs. Still one episode is left, and that, of course, I say that would be very, very useful, because we would try to collate all judgments from Supreme Court and High Courts, focusing on RBI guidelines and ARC structure in India. So again, I would say Mr. Mishra to give his closing remarks. Of course, we cannot have the time now for attending to more questions, but Mishra can give us the closing remarks on the ARCs.
What I would like to give is how ARCs are evolving or how ARCs are changing. Number one, the migration of retail loans is much more visible. As on March 24, retail was 15% of the total dues acquired by ARCs. But during the year 2024-25, the dues acquired constitute around 37% of the fresh business of ARCs. So there is a noticeable shift towards retail, one. Number two, as far as resolution is concerned, nowadays this restructuring is having the dominant say. For example, in March 2024-25, there was a recovery of 46,000 crore, out of which settlement was around 8,000 crore, another 8-9,000 crore by asset sale, but rest of this were from in-house restructuring and others. So which is a big amount, and which includes, of course, IBC also. So around 30,000 crore from IBC or in-house restructuring by ARCs themselves. So earlier ARCs were treated as only say through asset sale or settlement. That is changing now. Last year, 2/3 of recovery came from restructuring either through IBC or in-house. Number two, so resolution studies, there is a complete shift towards restructuring, and more ARCs are recruiting vertical specialists to ensure in the transition. And this migration of retail, in fact, a few days back, I was seeing an ad of one of the ARCs recruitment job ad description. When somebody reads that, you would find that that is for maybe Microsoft, maybe for Google, not for an ARC. The type of people that are being recruited are data scientists, those who are conversant with AI, those who are conversant with data analytics. So the quality of manpower is also shifting towards more tech-savvy, more AI-driven, and gradually, I mean, ARC are trying to build niche into niche segment. Somebody is doing pretty focused on the real estate, somebody is doing on industrial loan, somebody is building up retail infrastructure. So the journey continues. I mean, the challenges are varied, but ARCs are coming up with innovative ways to address all those challenges, and they have been there for last 20 years, and certainly they would continue as there is no sunset clause.
Thank you so much.
All those
Yes.
cases like SASF and others where they cannot be resolved, ultimately it has come down to ARCs. Last
Yes.
year, SASF closed down its portfolio and sold to one of the ARCs.
Right.
So
Right.
that shows at the end of the day, ARCs are the last resort for resolution.
So I think the ARCs are in fact going great nowadays, and the future of ARCs in fact is seen as a bright future. Also, the RBI has now stipulated that all of them has to achieve the net owned funds of 300 crores by 31st March 26. So that means that the RBI is also thinking to place more reliance on ARCs. Although the RBI is also considering the RBI-led framework for resolution of stressed assets, and where the assignment can even be made to assignment of NPAs can be even made to other than ARCs. So that, of course, it is still in making, but the draft guidelines has also been released by RBI.
I would supplement that with only one line. in the whole piece of securitization of stress asset, the role of resolution manager is very critical. And as far as resolution manager or REM is concerned, there is no substitute to ARC at the given time. So ARC will continue to have a dominant play in that space also whenever the final guidelines are there. And of course, we have also requested RBI to allow a fair playing field with other investors in various ways. So there are challenges in any business or industry. There are challenges, and of course, when one has to gear up and one has to address all those challenges to survive in the game. And sure, we'll try to do that. And thanks for all your efforts in doing such a wonderful series of sessions actually. And wishing you all the best in the next session also, legal judgments and others. In case you require any help, I would give a best of our legal team from any of the ARCs to help you.
Certainly, we'll seek your help, and we convey our heartiest thanks to you, sparing time and taking all these pains to participate, and only for the benefit of the for our audience who are actually learning, or they are kind of updating themselves regarding the ARC, regarding ARC SARFAESI law, regarding RBI. So this is what is our endeavor. And Mr. Mishra, this is from our side, we can only say that this is our way of learning. Thank you very much.
Thank you very much
for participating.
Thank you, Mr. Mishra. Thank you, everyone. Thank you so much for joining us today.
Thank you.
Thank you, everybody.